Welcome back, everyone. Well, CIT is stunning Wall Street this past week, taking charge of nearly $500 million to get rid of its home lending business, which was mostly in the subprime market. But to take that kind of hit just to get out of the business, does that mean that there could be bigger problems down the road for mortgages in America, maybe our mortgage? Time to go head-to-head. Alexis, what do you think?
Well, I think there's a twofold issue here. You know, one thing, you have Bernanke signaling out to the marketplace that yes, foreclosures and mortgage rates, it is an issue. But he also signaled to us, you know what, lenders, you have to participate in the battle. You know, there's all this question over liar loans. Who's responsible? Is it the consumer because they lied? Is it the lender because they didn't, you know, do their fiduciary responsibility? And I think the signal he sent to the marketplace is, you know what, I'm going to put pressure on the banks to make sure that you come up with a suitable solution to make sure that people can pay down their debt. So do I think it's a colossal issue for the marketplace? No. I think it is a specific issue, but it's something we will look at and regulate and determine if this kind of thing can happen again. You
know, Patricia, the only thing where I would slightly disagree with Alexis is when Bear Stearns essentially writes off two funds, effectively saying you're worth zilcho, I begin to think of all the other guys out there who also support finance and indirectly or directly countenance these funds. Just a matter of time before others drop too.
All those shoes have not dropped yet. I agree with that. I think Bear Stearns and CIT and GE announced that they were getting out of they were selling off their subprime lending business. I think that's the tip of the iceberg, and I think we're all going to feel that pain. It's not a quick fix.
When you say feel the pain, what would happen?
Well, I think what it's already started to happen. You see credit tightening, so you see real estate falling. Last year, according to the Wall Street Journal, 20% of the loans, the mortgage loans that were outstanding were subprime. So when you think about that, that takes 20% of the buyers perhaps out of the market this year. Real estate has a long way to go. The average guy in this country uses his house as a piggy bank, and now he can't necessarily find the credit line anymore for getting money out of that house. In May, we had a surge in consumer debt, 9.8 on an annual basis in the category that deals with consumer credit. That means to me that the average guy is going out there and putting things on his credit card where he used to take it out of the home. That's not even tax deductible.
So that would be bad for the consumer. Ben Stein, you agree we have a consumer hiccup to worry about?
Not at all. I think Ms. Glick was totally correct. This is a tiny blip in the overall markets of this country. Subprime is 15% of mortgages. Of that, roughly 15% of that 15% is either delinquent or late in paying. Of that, there'll be a recovery of 80% or 70%. That the total loss is going to be minuscule compared with the size of the mortgage market altogether. I think this is just an excuse for hedge fund traders to manipulate the markets. It will be very bad for the people who lose their homes. It'll be very bad for a few mortgage companies, but overall it is just a hiccup. I would not let this stop me from investing for 1 second.
What do you think of that, Trace?
Well, I think Ben is right in that it's a blip to the economy, but I think how we're going to feel it is, to Alexis's point, Bernanke wants the banks to crack down. You're going to start to see the big financial institutions struggling to get loans because they don't know how to handle this going forward. Credit availability, the ability to get loans is going to get tougher.
But it already has, right?
Not just for the mom and pops, though, not just for the people buying homes, for corporations that want to build plants in other parts of the world. I think that's where we're going to start to see it,
wouldn't lenders distinguish between those guys and people of marginal credit?
At this point, they don't know how to digest this problem. The market doesn't know how to digest this problem. This problem is very new to the market. You know, we could handle just about anything now, from terrorist attacks, gas, we got it all down. This is new, and the market doesn't know what to do with it yet.
What do you think, Jones?
Well,
I don't think it's Ben. Go ahead.
With respect, we do know how the market is handling it. It shows in the metric of the increase in the rate on junk bonds, and that increase has been very, very small. So really the junk bond market is digesting the junk mortgage problems quite nicely.
Yeah, I agree with Ben. I don't think this is going to be a big problem for Wall Street. In fact, the reality is that for the average person out there who's struggling to buy a home, it's a disaster. All the big quality names are getting out of this business. There's just going to be a bunch of snakes laying around. Also this week, Bernanke talked about licensing mortgage brokers and bankers, you know, federally, because it's just already it's a racket to a certain degree. So I really feel sorry for the real low end of folks who are busting their butts trying to make it, because they're going to get taken to the cleaners when all the big quality names in this industry move away. As far as the macro economy is concerned, everyone's talking about subprime being more of a problem, but no one's saying Alt A or prime, because it's not going to be a problem.
All right.